Ted Williams wrote a book called The Science of Hitting. And in The Science of Hitting, he's got a diagram, shows him at the plate. And he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and, you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game. And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time.
That analogy sums up perfectly how I think about investing. What Warren is saying is that Ted Williams became one of the greatest hitters in baseball history because he didn't swing at every pitch. He waited for the pitches that were in his sweet spot, where he had the highest probability of success. Investing works the exact same way. Every company that comes across your screen is another pitch. Some of those companies are good businesses. Some of them may even outperform the market in the long term, but you don't have to swing. There are no called strikes in investing. I'm not looking for good. I'm looking for exceptional. I'd rather own 5 exceptional businesses that I understand inside and out than 20 businesses that I only sort of understand. I look at it like my portfolio only has a limited number of seats. Every company is competing for one of them. And once I have a company's financial statements in front of me, it usually only takes a few minutes to decide whether it deserves a closer look. And great businesses have a way of standing out. Today, I'm going to show you 5 of the first filters I look at. If a company can't pass these, I simply move on. Because as the analogy goes, there's always another pitch. So let's get started with filter number 1. The first thing I ask has nothing to do with valuation. It is, do I understand the business? Can I explain how it makes money? Who are its customers? Why do those customers choose this company? What gives it an advantage over its competitors? And what realistically could disrupt this business over the next 10 years? If I can't confidently answer those questions, I don't invest. Not because it's a bad company, but because I don't have to. Take Palantir. This is simply a company I just don't understand. I'm not saying Palantir is a bad business. It may turn out to be an incredible investment over the next decade. But when I'm looking to fill that next seat in my portfolio, this company is outside my circle of competence. If I can't confidently explain the business to someone else, I'm not comfortable owning it. Because there are too many exceptional businesses out there that I do understand. And conviction comes from understanding, not from hoping. Now, once I understand a business, the next question is, does it have a moat? A moat is simply something that makes it incredibly difficult for competitors to take customers away. Ask yourself, does the company have pricing power, a powerful brand, high switching costs, network effects, patents, cost advantages? And one of my favorite examples of a strong moat is MasterCard. Every new merchant that accepts MasterCard makes the network more valuable for customers, and every new customer using a MasterCard makes the network more valuable for the merchants. That creates an incredibly powerful flywheel that's almost impossible to replicate. And while you have companies like Visa, these two operate almost like a duopoly. They complement each other and give investors the choice to pick which one they want to own. So when I'm hunting for great businesses, a moat is exactly what I want. I'm looking for businesses that can still dominate their industry 20 years from now. Filter number 3 is management diluting shareholders. A great business can still become a poor investment if management consistently dilutes dilutes its shareholders. And one of the first charts I pull up when I'm investing is shares outstanding. And unlike other charts in investing, this is one you typically don't want to see going upwards. Now, not all dilution is bad. Stock-based compensation can help attract talented employees. Issuing new shares can help a business acquire another great business that can help create more value for its shareholders. But when I see companies like Snowflake, Rivian, AMC issuing large amounts of new shares year after year, I immediately start asking questions. Like Snowflake, for example, why is their stock-based compensation year after year higher than their free cash flow? Or companies like AMC year after year continuing to issue more and more shares. Or you have a business like Rivian, which makes beautiful vehicles but is doing the exact same thing. These are all forms of diluting shareholders. The more shares they issue, the less ownership you have. And for a seat in my portfolio, there has to be a great justification for something like this. So when I'm hunting for the next great business, I have a limited number of seats, and diluting your shareholders is not going to earn you that. The next filter I want to take a look at, and that is, does the company generate real cash? Now, this is one of my favorite filters because companies can report impressive revenue and they can report adjusted earnings, but cash is much harder to manipulate. And that is exactly why I focus on free cash flow. After paying all the bills and after investing back into the business, how much cash is actually left? Take FICO as an example. This is one of the reasons I own this company. It consistently generates strong free cash flow. That cash gives management options. They can reinvest into the business, buy back shares, reduce debt, make acquisitions, or return capital to shareholders. Now compare that to companies burning cash year after year. They eventually have to raise more capital, and that's not the kind of business I want to own. The next filter on the list that I immediately take a look at, and that is, can the company comfortably handle its debt? Debt itself doesn't scare me. Some of the world's best companies responsibly use debt. The question is, can they comfortably handle it? Take Warner Bros. Discovery as an example. This company has spent years trying to work through a massive debt load. Now compare that to Berkshire Hathaway. Berkshire has nearly $400 billion in cash and treasury bills. Think about the flexibility that gives Warren Buffett. When the next recession comes, he isn't worried about survival. He's looking for opportunities. And strong balance sheets create opportunities. Weak balance sheets limit it. Now, personally, I would much rather invest in a company that has the flexibility to play offense rather than one that consistently is forced to play defense. And the last filter I take a look at, which is usually just a bonus for me, is the dividend. And more specifically, is that dividend actually sustainable? And before I ever get excited about a high dividend yield, I ask one question: where is the money coming from? Dividends don't just magically appear. They are paid from the cash the business generates. That's why I focus on the free cash flow payout. Take Verizon as an example. Verizon has an attractive dividend yield of nearly 6%, but pays out roughly 66% of its free cash flow as a dividend. That means for every $100 the business generates, about $66 goes directly to shareholders. The remaining cash stays with the business to pay down debt, invest in growth, or strengthen the balance sheets. Now, for a mature telecom company, that's not necessarily a bad thing. But if I see a company paying out nearly all of its free cash flow, or even more if it generates year after year, eventually something has to give. The dividend gets cut, the company takes on more debt, or future growth suffers. So while I started as a dividend investor and I would chase those high yields, this is one thing I am very cognizant of today. And while I appreciate companies returning money to its shareholders in the form of dividends, I would much rather own a business that generates more free cash flow that they can continue to invest in themselves while still rewarding shareholders in the process. And personally, I don't feel comfortable owning a business that pays out more than half of its free cash flow as a dividend. While this may be good in the short term for the shareholder, it can certainly stunt growth in the future. So those are 5 of the first filters I use whenever I analyze a company. And honestly, most businesses never make it past this stage, and that's okay. Because investing isn't about swinging at every pitch. It's about having the discipline to wait for the right one. There are thousands of publicly traded companies, many of which are good businesses. But I'm not looking for good, I am looking for exceptional. Businesses I understand. Businesses with moats. Businesses that generate real cash, and businesses with management that thinks like the owners. companies with a strong balance sheet. Those are the companies that earn a seat in my portfolio because just like Warren Buffett said, there are no called strikes in investing. If this isn't my pitch, I let it go by and wait for the next one. Now I'd love to hear from you. What's the first thing you look at when you're researching a new company as a potential investment? Let me know down in the comments. And if you want more content just like this, the video on your screen right now, YouTube thinks you're gonna like. So I appreciate you watching, and I will see you in the next one.